Welcome to our comprehensive guide on financial modeling. In today's fast-paced business environment, understanding financial modeling is essential for making informed decisions. Whether you're an entrepreneur, analyst, or manager, mastering this skill can help you forecast outcomes, evaluate investments, and drive growth. Throughout this video, we'll explore the fundamentals, practical applications, and advanced techniques of financial modeling. Let's start by defining what financial modeling is and why it matters in the world of business and finance. Financial modeling is the process of creating a mathematical representation of a company's financial performance. These models are used to analyze business scenarios, forecast future outcomes, and support decision-making. By using spreadsheets and various financial tools, professionals can simulate different strategies and assess their impact on profitability, cash flow, and valuation. Understanding the basics of financial modeling is the first step toward making smarter business choices. Financial model typically includes several key components: assumptions, inputs, calculations, and outputs. Assumptions are the foundation, representing expectations about market conditions, costs, and revenues. Inputs are the actual data points, such as sales figures or expenses. Calculations transform these inputs into meaningful metrics like net income or cash flow. Finally, outputs are the results that help stakeholders make decisions. Understanding each component is crucial for building reliable models. There are various types of financial models, each serving a unique purpose. The most common include the three-statement model, discounted cash flow (DCF) model, merger and acquisition (M&A) model, and leveraged buyout (LBO) model. Each model is tailored to specific business needs, such as valuing a company, analyzing investments, or planning mergers. Knowing which model to use is essential for accurate analysis and effective decision-making. Three-statement model integrates a company's income statement, balance sheet, and cash flow statement. By linking these statements, analysts can see how changes in one area affect the others. This model is fundamental for understanding a company's financial health and is often the starting point for more complex analyses. Building a three-statement model requires attention to detail and a clear understanding of accounting principles. DCF model is used to estimate the value of an investment based on its expected future cash flows. By discounting these cash flows to their present value, analysts can determine whether an investment is worthwhile. This model is widely used in valuation and investment analysis, helping professionals make informed decisions about acquisitions, projects, and more. M&A models are designed to evaluate the financial impact of merging two companies or acquiring another business. These models help determine whether a deal will create value, assess synergies, and forecast post-merger performance. Building an M&A model requires a deep understanding of both companies' financials and the ability to project combined results. LBO models are used to analyze the feasibility of acquiring a company using a significant amount of debt. These models help investors assess risks, returns, and the impact of leverage on financial performance. LBO modeling is complex and requires careful consideration of debt structures, repayment schedules, and exit strategies. Assumptions are the backbone of any financial model. They represent expectations about market conditions, growth rates, costs, and more. Building realistic assumptions requires research, industry knowledge, and a clear understanding of the business environment. Accurate assumptions lead to more reliable models and better decision-making. Once assumptions are set, the next step is inputting data. This includes historical financials, market trends, and operational metrics. Accurate data entry is crucial for model integrity. Analysts often use spreadsheets to organize and validate inputs, ensuring that calculations are based on reliable information. Calculations transform raw data and assumptions into meaningful financial metrics. This includes projecting revenues, expenses, profits, and cash flows. Using formulas and functions in spreadsheets, analysts can automate calculations and ensure consistency. Proper calculation techniques are essential for accurate modeling. Outputs are the results of the model, such as net income, cash flow, and valuation. These outputs help stakeholders understand the financial implications of different scenarios. Clear and concise outputs make it easier to communicate findings and support decision-making. Scenario analysis involves testing different assumptions to see how they affect outcomes. By modeling best case, worst case, and base case scenarios, analysts can prepare for uncertainty and make more resilient plans. This technique is vital for risk management and strategic planning. Sensitivity analysis examines how changes in key variables impact model results. By adjusting inputs like sales growth or cost assumptions, analysts can identify which factors have the greatest influence on outcomes. This helps prioritize areas for improvement and focus on critical drivers. Forecasting is a core part of financial modeling. Techniques range from simple trend analysis to complex regression models. Accurate forecasting helps businesses plan for growth, manage risks, and allocate resources effectively. Choosing the right technique depends on the data available and the business context. Valuation is a key objective of financial modeling. Common methods include DCF, comparable company analysis, and precedent transactions. Each method has its strengths and limitations. Understanding valuation techniques helps analysts determine the fair value of a business or asset. Startups face unique challenges in financial modeling, such as limited historical data and high uncertainty. Models for startups focus on growth projections, funding needs, and cash flow management. Building flexible models helps founders adapt to changing conditions and make strategic decisions. Corporations use financial models for budgeting, forecasting, and strategic planning. These models are often more complex, incorporating multiple business units, markets, and products. Accurate modeling supports corporate growth, risk management, and performance evaluation. Investment professionals rely on financial models to evaluate opportunities, assess risks, and make portfolio decisions. Models help compare different investments, project returns, and optimize asset allocation. Robust modeling is essential for successful investing. Real estate modeling involves projecting cash flows, valuing properties, and analyzing investment returns. Models help investors and developers make informed decisions about acquisitions, development, and financing. Real estate modeling requires specialized knowledge of market dynamics and property valuation. Project modeling is used to evaluate the financial viability of new initiatives such as product launches or infrastructure investments. Models help estimate costs, revenues, and returns, supporting go-no-go decisions. Effective project modeling ensures resources are allocated wisely. Budgeting models help organizations plan and control expenses. By projecting revenues and costs, these models support financial discipline and goal setting. Accurate budgeting models are essential for maintaining profitability and achieving business objectives. Forecasting models predict future performance based on historical data and assumptions. These models help businesses anticipate trends, manage risks, and seize opportunities. Effective forecasting is a cornerstone of successful financial planning. Performance evaluation models measure business results against targets. By analyzing key metrics, these models help identify strengths, weaknesses, and areas for improvement. Performance modeling supports continuous growth and strategic refinement. Risk management models identify, assess, and mitigate financial risks. By simulating different scenarios, these models help organizations prepare for uncertainty and protect assets. Effective risk modeling is vital for long-term stability and success. Strategic planning models support long-term decision-making by projecting outcomes under different strategies. These models help leaders evaluate options, set goals, and allocate resources. Strategic modeling is essential for achieving sustainable growth. Fundraising models help businesses estimate funding needs, project investor returns, and structure deals. These models are crucial for startups and growing companies seeking capital. Accurate fundraising modeling attracts investors and supports successful financing. Mergers require detailed financial modeling to assess synergies, costs, and post-merger performance. Models help companies evaluate potential deals and plan integration. Effective merger modeling supports value creation and smooth transitions. Acquisition models evaluate the financial impact of buying another company. These models project returns, analyze risks, and support negotiation. Accurate acquisition modeling is essential for successful deal-making and value realization. Financial modeling is a powerful tool for business analysis, decision-making, and strategic planning. By mastering modeling techniques, you can unlock new opportunities, manage risks, and drive growth. Whether you're building models for startups, corporations, investments, or projects, the principles remain the same: accuracy, clarity, and adaptability. Continue learning, practicing, and refining your skills to become a financial modeling expert.